All right, welcome back, everybody. This is Hungry for Moat. We read all the smart literature by smart investors, and we've been reading the Buffett partnership letters. This Today we will be reading 1962, the third letter actually for that year, but I would say it's actually the second letter. He's been doing 6 month letters now, and it's going to be a very long letter, so we're going to try to avoid any other stuff and kind of jump directly into the letter. You have anything to add, Avinash?
Nope. And again, my awesome, very good looking co host Prabhat here and myself, Avinash. We're excited that we're still continuing this. It should be fun.
All right, all right. I am so looking forward to this letter. I think it's gonna be a juicy one.
Yes, let's dive right in.
All
So
right.
let's start with the letter. Okay.
If we have written on January 18, 1963, ground rules. Some partners have confessed, that's the proper word, that they sometimes find it difficult to wade through my entire annual letter. Since I seem to be getting more long-winded each year, I have decided to emphasize certain axioms on the first pages. Everyone should be entirely clear on these points. To most of you, this material will seem unduly repetitious, but I would rather have 9 partners out of 10 mildly bored than have 1 out of 10 with any basic misconceptions. In no sense is any rate of return guaranteed to partners. Partners who withdraw one half of 1% monthly are doing just that, withdrawing. If we earn more than 6% per annum over a period of years, the withdrawals will be covered by earnings and the principal will increase. If we don't earn 6%, the monthly payments are partially or wholly a return of capital. Any year in which we fail to achieve at least a plus 6% performance will be followed by a year when partners receiving monthly payments will find those payments lowered. Whenever we talk of years' gains or losses, we are talking about market values. That is, how we stand with assets valued at market at year end against how we stood on the same basis at the beginning of the year. This may bear very little relationship to the realized results for tax purposes in a given year. Okay. Um, Whether we do a good job or a poor job is not to be measured by whether we are plus or minus for the year. It is indeed to be measured against the general experience in securities as measured by the Dow Jones Industrial Average, leading investment companies, etc. If our record is better than that of these yardsticks, we consider it a good year, whether we are plus or minus. If we do poorer, we deserve the tomatoes. Okay. Um, while I much prefer a 5 year test, I feel 3 years is an absolute minimum for judging performance. It is certainly that we will have years when the partnership performance is poorer, perhaps substantially so, than the Dow. If any 3 year or longer period produce poor results, we all should start looking around for other places to have our money. An exception to the latter statement would be 3 years covering a speculative explosion in a bull market. I am not in the business of predicting general stock market or business fluctuations. If you think I can do this or think it is essential to an investment program, you should not be in the partnership. I cannot promise results to partners. What I can and do promise is that our investments will be chosen on the basis of value, not popularity. That we will attempt to bring risk of permanent capital loss, not short term quotational loss, to an absolute minimum by obtaining a wide margin of safety in each commitment and a diversity of commitments. And my wife, children, and I will have virtually our entire net worth invested in the partnership. Okay. plus a beautiful
Awesome.
first page.
Yeah. Okay,
And
let's
he's yeah.
maybe stop for a little bit and just talk about the expectations that he's laying out for the partnership, what he calls kind of the golden rules. Um, well, two things kind of stuck out to me, and I'm curious to know your thoughts. One is don't expect crazy returns when it's a very bullish market, and then so he says that outright. And then second is please judge me only after 5 years. 3 years is an absolute minimum, but 5 years is what it takes to really see if I'm doing a good job or not. And what I also like, maybe a third thing to add, is that everything that he has, along with his family's net worth, is invested in his property. So pretty fair.
I think that's very. I mean, he just said my investors. That's my immediate family as well.
Yeah.
That everybody's in this. So you're not wondering is he finding and keeping the really good ideas for himself? He's not. And yeah, he says not just better than market. He's saying no returns are guaranteed.
Yeah.
So do your own. There's a risk, but I'm in this with you. Whatever happens. And he has a system that people who wants those monthly payments can do so, and he's basically like, "We can do that. It's all your money that you have invested with me, or you keep lowering that amount each month. That's your choice. I mean, whatever your financials will support. It doesn't really gain you any benefits. It's not like you're making more money. Uh, yeah, probably doing a above below average job by withdrawing your money from the pool that you have given Warren Buffett to invest.
Yeah.
And of course, compare me to the Dow, and most of the time overall, we should be beating the Dow. If you're not, then let's just all, including Warren Buffett, should find a different person to manage his money.
Yep.
Yeah, and he can't tell the future despite what people believe.
Okay, this is pretty
And
straightforward.
yeah, it
Yeah.
doesn't go for popular stocks. He's value oriented. He looks at the value and lowers the risk to minimum risk
Yeah.
by getting the wide margin of safety. That's a good refresher. Nothing new, nothing surprising, but
Yeah.
always good to kind of just go back to that.
Yeah.
Okay. Our performance in 1962. I have consistently told partners that we expect to shine on a relative basis during minus years for the Dow, whereas plus years of any magnitude may find us blushing. This held true in 1962. Because of the strong rally in the last few months, the general market, as measured by the Dow, really did not have such a frightening decline as many might think. From 731 at the beginning of the year, it dipped to 535 in June, but closed at 652. At the end of 1960, the Dow stood at 616. So you can see that while there has been a good deal of action the past few years, the investing public as a whole is not too far from where it was in 1959 or 1960. If one had owned the Dow last year, and I imagine there are a few people playing the high flyers of 1961 who wish they had, they would have had a shrinkage in market value of about 10%. However, dividends of approximately $23 would have been received to bring the overall results from Dow for the year to minus 7.6%. Our overall record was plus 14%. Below, we show the year by year performance of the Dow, the partnership before allocation to the general partner, and limited partners result for the full years of Buffett Partnership Limited and predecessor partnerships activities. All right, so here we have this table of 957 and all the way through conclusion of 1962. It tells you the annualized returns of Dow, and you can see there's negative 8%, 38, positive 20, -6, and then positive 22, and overall negative 7.6, which is already better. I mean, it was almost negative 22 in the first 6 months of 1962, but looks like there was a rally at the end of the latter half of that year. And let's look at the partnership results overall.
It's all
Assuming
positive.
Buffett had, yeah, I mean, it's like there's no negative. He was kind of negative in the first 6 months of 1962, and then clearly the rally helped him
Mm-hmm.
become positive as well. 10%, 40.9%, 26%, 23%, 46%, 14%. I mean, this is like his
Wow.
worst year is 10%, while the market was actually negative. I mean,
Yeah,
that's beautiful. That is a
that's
beautiful,
incredible.
beautiful comparison to the index,
Yeah,
not like not a bond, not anything else, to the index. I mean, he's 10, 15, 20 points ahead of the index. Even on the
yeah,
bull markets. There
yeah.
hasn't been a bull like yeah, right? There's no
That's
bullish
right.
year where the Dow is done better.
Yeah, that's right. This one came to the closest 1958, but even
But
then,
it's
a
still
few
positive,
percentage
I mean.
higher. Yeah.
And now there's partnership. Now let's see what the limited partners actually got. Because the better the performance, the bigger bite that
Mm-hmm.
Buffett takes, you know?
And if we were to be invested in Buffett right now, this is the returns that we would see. So,
Correct.
um,
Correct.
yeah.
So slightly lower, 10, the partners got 9.3 compared to 10.4. On the 40, probably, that's a big, hit for the partners. Got 32 compared to 40, like
Mm-hmm.
41 almost. And the limited partner ended up getting less than the Dow in that scenario.
Mm-hmm.
And then 1959, limited partners did just as good as the Dow, whereas Buffett actually made 6% profit for the whole partnership and took a big chunk home.
Mm.
But the following year, partners 18, 19%. Dow was -6 and 61. Dow was 22. Limited partners 36. I mean that's a huge lead. And 62, of course, Dow -7. And
Mm-hmm.
limited partners almost 12%.
Yeah. Incredible. Yep.
Yeah. Wow. Wow. Way above those average 6 to 7%. I mean, it's constantly positive. That's now. I mean, if I had this information, I'm very curious. Like, should I be putting my money here
Mm-hmm.
if I
Yeah.
have these kind of results?
Yeah. I wonder if anyone pulled out in 1958 thinking, "Oh man, I can do better with the market. What am I doing here?" And then regretted it for the rest of their lives.
Yeah, maybe. I'm, marketed well, fine, as well. It's not terrible.
Yeah.
For 1957 to 61 consists of combined results for all predecessor limited partnerships operating throughout the entire year after all expenses, but before distribution to partners through allocation to the general partner. And 1957. So I'm just telling you what the table is. So we're gonna skip
Mm-hmm.
that and go to the next part.
Mm-hmm.
Okay. The following table shows the cumulative or compounded results in the same three categories, as well as the average annual compounded rate. So this is basically that was the annualized. This is the compounded.
Mm-hmm.
Um,
So he's
yeah, and,
compounded
and at
about
the,
26%. I
so
think the historical average for Buffett is like 20%. Is that right? Around there?
well
Overall.
here I mean yeah I mean overall if you say people say he's been compounding at 20% for like
Mm-hmm.
ridiculous amount of years and that's what makes him special.
Mm-hmm.
But yeah, so this is a good table. So you have all the cumulative Dow, cumulative from 57 to 62 went up 61%, 61.6%.
Mm-hmm.
And that's compound. That's not annualized. That's over the whatever 5 years or 6 years. Yeah, 6 years.
Mm-hmm.
And partnerships did almost 300%. Three
Jeez.
hundred percent. And of course,
That's
limited partners got
insane.
about 215. I mean, they like I guess that's tripling their money.
Yeah.
And
Wow.
of course, annualized, they saying 21%.
Yep. Still incredible. So 2x compared to the Dow, kind of. Incredible.
Yep. That is incredible. Yeah, the partnership with this 26. That's what Manish Babrai is like, right? 26 compound.
That's right.
So as a partnership, he's getting 26%.
Yep.
That's been Babrai's goal. So that's interesting how it's dead on
Yeah.
26%. That because if you do 26% annualized returns, you double your money in 3 years.
Oh, I thought it was 5. Is it 3 years? 72 divided by
15% is
26.
5.
Okay. Wow. Incredible. Wow.
So that's why
Yeah.
if you continue to do 26% annualized year after year for 30 years, then in 30 years you should be able to add three zeros to the amount you started with.
Say that again. One more easy
If you
math trick.
continue to do 26%
Uh huh.
annualized returns for 30 years,
Mm-hmm.
for 30 years, every year on average you're doing 26%,
Mm-hmm.
then at the end of the 30 years, you can add three zeros to the amount you started with.
Wow.
So a
Incredible.
million becomes a billion.
Wow. Okay. And $100 becomes 10,000
10,000.
per. So
That's right.
goes to show you gotta play with big money to make big money, I guess.
And Pavar's almost there. I mean, he's about to finish his 30 years.
Wow, and he's
He's only,
compounded at a 26% rate.
yes, I mean, his partnership is about seven. And in these kind of things, most of your, returns will come towards the end. So I think he's probably 2, 3 years away from hitting his 30 years.
Mm,
So he should be about, I mean, he's going to double his money. I mean, so it's probably half of his target right now.
incredible. Wow, very
Indeed.
impressive.
Indeed. Okay. My unscientific opinion is that a margin of 10% percentage points per annum over the Dow is the very maximum that can be achieved with the invested funds over any long periods of years. So it may be well to mentally modify some of those above figures. Partners have sometimes expressed concern as to the effect of size upon performance. This subject was reflected upon in last year's annual letter. The conclusion reached was that there were some situations where larger sums helped and some where they hindered, but on balance, I did not feel they would penalize performance. I promised to inform partners if my conclusions on this should change. At the beginning of 1957, combined limited partnership assets totaled 303,000 US dollars and grew to 7 million US dollars at the
Wow.
beginning of 1962. To date, anyway, our margin of the Dow has indicated no tendency to narrow as funds increase. So it's basically saying being big is not slowing me down. It's
Mm-hmm.
actually sometimes slows me down, but it actually also opens other opportunities, kind of balances. And clearly, there's been a huge influx of money. I mean, there so many people have dumped money towards Buffett. It's like, here, you invested for me.
Mm. Yeah. So he doesn't have that burden of large amounts of money just yet. This is still he can
I mean,
still compound at this rate.
he still thinks he's playing with a lot of money, but he just doesn't think that he's been hindering him.
Mm-hmm.
Any.
So if I'm reading this correctly, this means if you had $300,000 and you put it in 1957, and then you pulled out at 1962, you'd have $7.2 million
No, no,
dollars.
no, no, no. He's just
No.
saying total number of assets. That includes you start with 303, and at the
Mm-hmm.
end there were 7 million, and that's partly because of growth, partly and partly because of more people wanting to invest.
Oh, okay. So more people putting into the fund,
Yep.
but it's not because of the compounding that it grew to that size.
Not
Yeah. Okay. Gotcha.
now I have $7 million that I have to manage, and I still feel comfortable. You know, trying
Yeah.
to. I don't feel like I'm too big to do like not do certain things.
Yeah. Makes sense.
Okay. Next section: investment companies. Along with the results of the Dow, we have regularly included the tabulation on the two largest open-end investment companies, mutual funds, following a common stock policy, and the two largest diversified closed-end investment companies. These four companies, Massachusetts Investor Trust, Investor Stock Fund, Tri-Continental Corp, and Lehman Corp, manage over $3 billion and are probably typical of most of the $20 billion investment company industry. My opinion is that their results parallel those of most bank trust departments and investment counseling organizations, which handle in aggregate vastly greater sums. The purpose of this tabulation, which is shown below, is to illustrate that the Dow is no pushover as an index of investment achievement. The advisory talent managing just the four companies shown commands annual fees of approximately $7 million, and this represents a very small fraction of the industry. Nevertheless, the public batting average of these highly paid talent indicates results slightly less favorable than the Dow. In no sense is the statement intended as criticism. Within their institutional framework and handling the many billions of dollars involved, I consider such an average results virtually the only possible ones. Their merits lie in other than superior results. Uh, Both of our portfolio and method of operation differ substantially from the companies mentioned above. However, most partners, as an alternative to their interest in the partnership, and would probably have their funds invested in media producing results comparable with investment companies. And I, therefore, feel they offer a meaningful test of performance. So basically, here, same thing. He's saying these. What are you gonna do if you don't want to invest, in my fund, you
Mm-hmm.
know, and you can probably gonna invest in one of these mutual funds. I don't think they have means to invest directly in the Dow. There may
Mm-hmm.
be that sort of index fund set up, but basically saying if you had put in these other popular mutual fund type funds, uh, then you would kind of have Dow like performance or slightly less than Dow like performance. And
Mm-hmm.
he gives these numbers, what limited partners did on the very right, and what the other ones are doing on the left, and the Dow kind of second from the right.
Mm-hmm. Yeah,
And we
I mean,
can,
really, I guess he's just comparing himself not against the Dow, even though he says that's really the main yardstick. He's comparing himself with the other
yeah.
trust funds, or
And
maybe
he's saying I could compare myself to those, but Dow is actually the harder, more powerful
comparison.
comparison. Like I mean that's him being very
Mm-hmm.
very conservative because it's easier to beat the other guys.
Yep.
And you can see that. I mean, I think yeah, I mean, you can look at it, and it seems like Dow has beaten all of them most of the time, and sometimes some of these companies get anywhere from, uh, I guess, maybe 6-8% um, lead in some years, but then they lose out. So overall, Dow I think is beating them.
Mm-hmm. But it does seem like this that seems like Tri-Continental, I guess, that these guys seem like they're doing better than the rest of the three.
Well,
But
let's look
even
at it.
then,
Go compound it. Go next table right below it.
I see. Okay.
Let's look at the last column. It just tells you compounded if you had just left your money in there for those 6 years. Dow would have, limited partners got
Oof.
215%. Dow give you 61.6%.
Wow.
Tri-Continental will give you 59.7%, so very close to the Dow.
Mm-hmm.
Lehman give you 48. Investor stock 53, and Massachusetts Investment Trust 54. So all
Yep.
of them did worse than the Dow. And Buffett did,
Oof.
I mean, what, four
Crazy.
times, no,
Wow.
almost 3 to 4 times that of what Dow did.
So, what? I mean, do we know which companies are in his limited partners right now? We don't, right?
What companies? I mean, I think that is an excellent question, and I think I can try to pull up that document that I had found. Um,
Oh yeah, the one with the picture, right? With all the companies on it, the Twitter picture.
Correct, correct,
Yeah.
correct.
But I mean, of course, we wouldn't be able to make too much sense out of it. But I wonder if there was like a category that was protected against, um, the down market in '57, but then did somewhat okay in the other years. I wonder what sector he was heavy on.
I don't think he was looking at sectors. I mean, I mean, clearly he has Berkshire. He has bought into presumably this year, but he owns Berkshire Hathaway as because the companies have merged at
Mm,
this point. Berkshire Hathaway have merged. They merged around 55, I believe.
mm,
And so he owns that at this point. He owns this company. He's probably going to talk about that's his mill company, um, in Omaha, I believe, Dempster.
mm-hmm,
And there are all these. I mean, it's kind of hard to read. It's this cursive. I think Alka, BCP, Crano, I mean, Destin. Is it Destin Boots? I don't know. No.
I'm not sure. Maybe you could flash up the
Here,
the
let me,
picture
yeah.
just so that. Yeah,
There we
interesting.
are. So, I mean, Dempster, this is the company that I think is going to talk about that he owns. Omaha. Here's the Berkshire. This is alphabetical list. Oil. There's an oil company, Getty Oil.
Mm-hmm. Okay, it seems like, yeah, again, going off of
Houston Oil.
principles. Yeah, so oil is pretty up there. But I guess he really isn't looking at it like a sector doing well. He's just looking at super valued,
Yeah,
undervalued
whatever's cheap.
companies.
No
Yep.
European oil. I don't know why the oil ones are not jumping out to me. Plymouth Oil,
Hmm.
Stockton Coal. I think that might be coal. So the energy companies, TNP. Yeah, so
Interesting.
I
Okay.
think it's just a little bit of everything.
Yeah. Yeah.
And look at this nine. I think that's a dollar amount, $9 million.
Hmm. It's incredible.
Beautiful. And yeah, this is December 31st, 1962, Buffett Partnership Limited.
So just a few months before this letter. Yep.
Yep, 1 year of operation. First purchase of Berkshire stock.
Hmm. I wonder why he wrote that.
I don't know. Maybe someone else wrote it. I don't know.
Okay.
But yes.
Interesting. Very cool.
Okay. I am going to. There we are. Perfect.
Okay. So wait a second. So let me see if I understood this correctly. So originally, if Columbus was having $30,000, left it alone, and then this date, which is 1962, he would have something like $2 trillion.
Well, he's questioning, like, was like these, the Isabella, I think that was the Queen of Spain, like they spent $30,000 for Columbus to go find a new route to India or find this new hemisphere.
Mm-hmm.
Like, even if they found, the whole, like they could claim and there was no conflict and they owned the whole all of the land, which they
Mm-hmm.
did, right? Spain is not really North America anymore.
Mm-hmm.
Like that was still a terrible investment. Better investment would have been just like invest that money at 4%, That's not asking a lot annually, and you'll have $2 trillion by now. Like that would have been a much better investment than doing these kind of startup type
Voyages. Yeah,
things.
this
Yeah,
venture capitalist stuff. Okay,
yeah,
gotcha.
yeah.
Okay.
And he says similar, like we've heard this story about like the Manhattan, the Indians, the Dutch bought the Manhattan Island from the Native Americans for like something ridiculous amount, and then I think if they had invested that money, the Native Americans that they received like, as cash compounded at a reasonable rate, I mean they would it'll be worth more than the value of island of Manhattan today. I mean, it's like, even though that's the prime real estate in the whole world, the time is such that you could have, you should
Made a
have
lot
more.
more money.
Yeah, yeah.
Right.
That's
Yep.
just crazy. With
That's right.
$1 million, I could get
Yeah.
50% a year.
Yeah, that's right. That's right. Even to the and that's today. He's not talking about.
Yeah,
Yeah. Yeah.
yeah. Or like maybe like 20 years ago, like 2000 around. But yeah, I think I'm sure it'll still be applicable
Yeah.
today.
Incredible.
let's just kind of go over that. He's talking about, again, the generals. This is kind of the typical value investment kind of attitude. There's no event guidance. There's no corporate action. He's saying these are stocks that are cheap, and they're cheap because there's really nothing going on. Like, there's no news coming out that something's going to happen, so they're kind of forgotten. And you buy them because they have margin of safety, and you just don't know when they will re-rate and go back to what their stock price should be. But when you buy them with good margins, and you buy a diverse basket of these stocks, you just can't help but become rich. I like that.
Maybe we should also talk about, with these generals, or kind of way of thinking where it's just undervalued. Really, you're not looking at the news; you're just looking at the numbers from the company, trying to understand the company. So a very bottoms up approach instead of like someone telling you, "Hey, this might be a good stock," and then you delve deep into it. Um, there might be some value there, right? Because anything that shows up on the news is usually what we tend to research. And really, I guess what the lesson here is, don't look at any of the stuff that other people are looking at. Look for just bottom up type of approach where you could, really value a company and see if it's undervalued and then buy it when no one else is talking about it.
I kind of agree. I think it's the fact that they can, yeah, other people are seeing it as well. I mean, it definitely, you're not being obscure enough. I think
Yeah.
as little guys, you can be very obscure in what you're looking at, where other guys are not looking at it. So if you're, the only thing is, I mean, if a stock is the news, I mean, the chances that it's going to be cheap is not very high. That means a lot of eyes are on it. There's interest. So that's the caveat.
Yep.
Okay, moving on. Many times generals represent a form of coattail riding, where we feel the dominating stockholder group has plans for the conversion of unprofitable or underutilized assets to better use. We have done that ourselves in Sanborn and Dempster, but everything else equal, we would rather let others do the work. Obviously, not only do the values have to be ample in a case like this, but we also have to be careful whose coat we are holding. Okay, interesting. This paragraph actually has something unique. We're gonna have to go over it again. So he's talking about these generals. Um, it's like you're kind of coattailing, the management, because sometimes the management is knows that they're gonna make a change. Maybe they can restructure the organization, or they can do something that's gonna unlock value, and as a result increase the stock price. So that's the underlying assumption, and sometimes he's saying we have to do that ourselves. Maybe um, under convert underutilized assets or unprofitable assets, and just kind of make them more productive. It's kind of management thing. And he's like, well, given the option, I don't really want to manage these businesses. I rather have somebody else do it. Um, but when we are doing it, I mean, it has to be like a big difference. Like if I do this change, that's gonna unlock a lot of potential. Then he may dig in and actually manage the business himself.
So what's interesting about this is that he acknowledges that having a hands-off approach and just delegating is the better way of him making money, so that he can, maybe focus on the investment side and not really the management side of it. But
Correct.
I guess, am I wrong in thinking he's actually doing the exact opposite, because he bought Berkshire Hathaway and he's going to have to take a very active role there.
No, I disagree. He's not taking a very active role. So there are the way to think about it is we're thinking about CEO, right? What is the
Yeah.
job of a CEO? People tend to think the CEO's job is running the business. That is incorrect. Most businesses have a chief operational officer whose job is to manage the operations. CEO job is to maximize value of the shareholder. So CEO has two jobs. Ultimately, CEO is in charge of making sure the operation of the business is working well. Like he's in charge of those chief operating officer. So assuming that operations are perfect, now CEO has to maximize stockholder value, which means all the cash that has been generated. So it's basically a capital allocation problem. What do you do with the money? It's so CEO, some will argue, actually should be called the chief investment officer. Do you use that money that you have from the business and grow the business? And will growing the business be the best thing for the stockholder value? And is it, and that kind of opens the Pandora box of, well, if growing the business is going to be great, should I borrow money on behalf of the stockholder? And that's where a CEO can destroy value. Or CEO can be like, well, I know this business can't really grow, but I'll just return this money to the shareholder as dividends or share purchase buybacks. In terms of Berkshire, he's just basically, Buffett is just buying a lot of well operated businesses, and these businesses are making a lot of money and giving Buffett the profit, and then Buffett decides, for this business, is it worth it for me to spend more money in growing this business, or should I just use this business, get the money, and see what I can do with this money? Maybe I can buy a different business, or feed a growing business that he already owns.
Interesting. So it's really so this you're saying the CEO's primary and only role should be where to invest the profits that they're getting.
Well, to maximize shareholder value. And assuming if you don't have a well-run business, then you need to focus on operation. You need to turn a business into a good business. And if you once you have a good business, then you think about what you do with the cash. Do you make the business even better, or do you just give the money back to the shareholder, or just buy back your stock?
Interesting. Okay, but I guess the life cycle or maybe the lifespan of the business would be to maybe put it all into the business first to grow, and then you'll have even more excess capital that you could then allocate towards something else or whatever, right? So this would be not early stage startups, of course, and even mid stage. This would be larger companies where you're already having a very stable operations, and then you'll have to expand out to these other investments and so forth.
Correct, correct. I mean, if you have an early stage business, then yeah, I mean, or if you have a business who is not the strongest financially,
Yep.
then obviously you want to focus on the business and make sure it turns into a good business. But
Yep.
when you're looking from investing, glasses, you don't want to buy a struggling business. You want to buy a good business with the moat. You don't want to buy a crappy business and with a good management thinking they will create a moat. That is a recipe for disaster. You want to buy an already good business, and hence why these value investors don't do well in the growth industry, because predicting the future is difficult. And what you can see is it's difficult to know how big of a moat Google will have or Amazon will have 20 years from now. But it's easier to say, like Geico, as long as people are driving, and people will drive, for it'll be, maybe self-driving will be a thing, but that seems like much of a long shot than Google failing at a 200 PE. I mean, that's more of a possibility, at least 10, 20 years ago. So hence, you need to, but when it's these suboptimal businesses, then it's tricky. I think that the CEO skill becomes turning the ship around. And 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 as an investor, I mean, if you go in, that's a risky investment, because
Yep.
the ship may not turn around and you
You're
may
right.
lose, or it may, and you may do really well. And that's maybe closer to gambling than true value investing, which is low risk, high reward.
Exciting, yeah. Two kind of examples come to mind in terms of like amazing capital allocators. Maybe three now that we've studied Tencent. First thing would be Trident. You know, they did that same thing where they just absorbed a. They had a lot of cash. They had enough money to buy different
Which business
companies.
you're talking about?
Trident. I don't
What
know
is that?
if Trident is this. It's this like manufacturing company for the military.
Okay.
Pabrai actually talked about it where there's this book. I forget the blanking on the name of it, but it talks about this company Trident, and it's kind of a fantastic business in that it just absorbed other companies that grew the money that they were getting in, so they had more cash. Not only did they do buybacks of their own share when it was pretty low, then they they just bought these other companies which made them more money, and then they had more money. So really at the end of the day they were just amazing capital allocators. All they really did was just they just made had more money to spend. So that's great capital allocation. Second one that comes to mind is Amazon. So you get all the money from the business. After that, you just put it right back into other expansion areas, whether that's buying companies or maybe you know either expanding your business, trying new things, maybe AWS, all this stuff with very long runways. So you get more money to try these different things. And then the third one I was thinking was Tencent. Tencent, fantastic capital allocators, especially after hearing Pabrai talk about it during the Boston talk. It's just amazing. It's just anyone. So maybe a good way to think about it is anyone who's growing their moat is a fantastic CEO. Anyone who is not growing their kind of cash flow are maybe not the best capital allocators.
Well, yeah, I mean, a good management from an operation point of view is somebody that's widening the moat year by year. I mean, look at Berkshire. I mean, perfect moat. I mean, they dominate the reinsurance business at this point, which even I don't understand. A lot of people don't understand. I would say just because unless you're in the insurance industry, most people are familiar with the tech. I mean, we know like Amazon and Google and Facebook, Apple. I mean, they're everywhere, and and they're visible to us. But I mean, Berkshire Hathaway at this point is probably a very very stable rock. I don't know like how quickly it'll move forward and grow, but I mean the downside that it's going to turn to zero. It's very very low.
Yep.
I mean it kind of dominates the financial sector unless I don't know like fintech and Ethereum and those create financial products that are vastly superior to the traditional insurance. I doubt it. I mean, like, how do you replace Ajit Jain, who does a
Yeah.
lot of the, bets, and I mean that requires a person to look at their situation and put a number on it. I mean, I don't think a blockchain can do that for these unique situations. Maybe for car insurance,
Yeah.
but yep. So yeah, a lot of these good. I mean, look at Apple. I mean, perfect moat. I mean, the walled garden approach. Really good financial balance sheets. You can't. It's hard to switch. I mean, the mode's definitely there. As far as capital
Yeah.
allocation, I don't know. I don't know like
Yeah.
how smart Tim Cook is, and I think they have a lot of cash.
Yeah.
And I don't know what they do with that cash. Maybe they do some
That's a
buybacks.
good. Great. That's a great question because if that thesis of okay, if you're able to delegate cash to the right directions, then you're a pretty good CEO. But of course, Apple's a good exception there because Tim Cook's sitting on a lot of cash, so maybe that's also fine. But hard to say if cash is great if you're a CEO. You would think that you
Well, you want to
should
use
be
it. You want to
expanding.
use it to the
Right.
maximum potential. Um, and it may be these incremental iterations, like I think maybe they have other projects in health and car. I mean, who knows what they
Yeah.
may be doing in secretively, but
But they
but
do
that
have a
would
lot
be
of
a good
cash,
use.
though.
Yeah, so I mean, maybe they're using it on that, or maybe I think they do some share buybacks for the shareholder, so that
Hmm.
way they can increase shareholder value with the cash.
Yeah. Interesting. Yep.
Um, okay. The generals tend to behave market wise very much in sympathy with the Dow. Just because something is cheap does not mean it is not going to go down. During abrupt downward movements in the market, this segment may very well go down, um, percentage wise, just as much as the Dow. Over a period of years, I believe the generals will outperform the Dow, and during sharply advancing years like 1961. This is the section of our portfolio that turns in the best results. It is, of course, also the most vulnerable in declining market. And in 1962, not only did we not make any money out of a general category, but I am even doubtful if it did better than the Dow. Oh wow, that's a big statement to say that this category itself did not do better than the Dow.
Hmm.
Okay. Our second category consists of workouts. These are securities whose financial results depend on corporate action rather than supply and demand factors created by buyers and sellers of securities. In other words, they are securities with a timetable where we can predict within reasonable error limits when we will get how much and what might upset the apple cart. Corporate events such as mergers, liquidations, reorganizations, spin-offs, etc., lead to workouts. An important source in recent years has been sellouts by oil producers
Hmm.
to major integrated oil companies.
This reminds me of that. You saw all the companies that Berkshire or Buffett partnership had, and you saw a lot of oil companies. Maybe that's why
Yeah,
that those are all of his spin-off companies or
correct. All right.
workouts. Question, quote
Yeah,
unquote workouts.
I guess they're going to be mergers, right? Someone's been
Yeah,
selling out, so there's consolidation happening.
yeah,
So you buy these companies that are about to merge, and then when they merge, it's a stronger stock, stronger company. So yeah, so maybe that's what he's doing with there,
yeah,
buying all these different ones.
yeah,
Interesting how this correlates with what he's doing actively, and then he
yeah,
mentions it.
yeah. That's fascinating. Okay.
This category
Um, uh, the one thing that I want to kind of mention, which is super risky, I guess you'll have to have very large confidence in your investing abilities, is to invest with borrowed money. But then he's saying here 25% might be too little. Maybe in some years it might benefit.
Sometimes, yeah,
Yeah,
but he doesn't necessarily want to go over 25%. But
yeah,
also, it's like 32, 33. He's borrowing $1.5 million at that time to buy these workout deals.
yeah,
He's these are leverage plays that are very calculated,
right.
and he feels very sure. And I mean,
Yeah.
the boy's a genius.
Yeah, yeah, and the conviction you have to have in your own beliefs. But
Yeah,
yeah. Oh, and I do want to kind of make a little amendment. So the book that I was thinking about was Distant Force from Teledyne, not Trident. Teledyne. That was the
Taladon.
yeah, that was
Oh,
the company which was like fantastic capital allocators, and that was the Manish Paprai book that he had suggested. But anyway, yeah,
okay.
fantastic.
Operation.
A
Yeah.
quick question. So remind me again what the Dempster Mill manufacturing company did. Do you remember? I don't really
That's
remember
what
this
he's telling
business.
you. They sell farm parts, water systems, water supply parts, plumbing lines. So a lot of
Yep.
farm and watering of farm
Okay.
kind of
But in the previous
industrial.
letters, did he say anything about like what they did, or is this kind of the first time he's telling us? Because I don't
He
remember.
may
I
have
remember the
mentioned
name, but
he may
yeah.
have mentioned them briefly. I don't think he went into a big
Okay.
detail on what they
Okay.
did.
Interesting. Okay.
buy into a you have a controlling share into the company, you don't really care what the market quote is. You basically care about
The
liquidation
asset
value,
value. Yep.
value of the assets,
Yep.
because that's what you can get. I mean, you don't have to sell the stock. You can actually sell things and get money. So assets in terms of
I
paid
thought
off
that
debt.
was that. So he's saying that instead of it being 30.
Valuing it conservatively is this dollar amount, and I'm paying less than that, so let's buy it.
Mm-hmm. Yep.
On general, basically a general from a crappy business into a general. So I was
Yeah.
saying now is it should, because it was kind of stuck and it was a liquid. Now it should behave more like the Dow.
So it used to be
Should
a
go up.
workout, but he's now saying it's going to be more of a general because he finds more value in the company.
Yeah, yeah, it was gonna be where he actually manages the business, turns it around.
Mm-hmm.
But now he's like, it's not working. I'm gonna sell it and turn and buy stock under this umbrella.
Mm-hmm. Yeah.
do his bidding and run businesses
What's
for it.
yeah, what's also interesting is he's like, this guy could come in handy in other businesses just in case something like this happens
Just
again.
because we have a good relationship. Yeah, like
Yeah.
question of new things,
Yeah.
risk, true risk is, you know, valuation with the margin of safety. Just buying bonds is not safe. Just buying blue chips that you think will, will be around just because there's inflation is also not safe because you may just be paying way too much because everybody has the same idea.
Yep. I love that last two paragraphs. I absolutely love. So, the quote, maybe it bears to repeat. You will not be right simply because a large number of people momentarily agree with you. You'll not be right simply because important people agree with you. In many quarters, the simultaneous occurrence of two above factors is enough to make a course of action meet the test of conservatism. And then I love that because it echoes exactly what's going on in today's market. And then the second also is very similar to what's going on in today's market, I feel. You will be right over the course of many transactions if your hypotheses are correct, your facts are correct, and your reasoning is correct. True conservatism is only possible through knowledge and reason. Dang. So stuff that we can't make sense about, we should just leave alone, honestly. That's what it's saying.
And also, the more I read it, the more I'm like, can I do this on my own? Like, there's
Yeah.
that doubt. It's like that seems like I need to like really be an expert that I can't just,
Yeah.
follow blindly. Well, I mean, yeah, you should be following. You should be doing your own. You need to be a good analyst, basically.
Yeah.
You need to have that knowledge and experience and reason. And
Yeah. Yeah.
I like to say I think we can, because I mean, the most people say you don't need to be, like super smart or Einstein. Like you just need to have little time and average IQ
IQ.
and just a desire.
Yeah. But really, I think the bigger thing might be just the dauntingness of the research. Like, how confident are you really if no one else is buying it? You're
Yeah, like
alone.
yeah,
It's so like, how good is your research? How good are you certain about the facts? How good is your reasoning? These
how
are
good is
only
the conviction?
questions. Yeah, these are questions you have to ask yourself in the mirror because no one else is there as a sounding board. Really, it's you got to answer to yourself. It's you got to put your mouth where your money is.
Good
That's
question.
scary, man. That's
It's
scary. I
scary.
don't know.
It's scary.
Yeah,
It's
very
not supposed to
difficult.
be easy.
Nope.
It is simple, but it's not supposed to be easy.
Yeah, I think Munger had a great quote where he's like, Getting rich. Why should getting rich be easy? Or something like
Yeah.
that. Yeah.
Or why should it be easy?
Yeah.
I might that badly, and
Yep.
that's the magic. That's when you'll be really impressed.
Hmm.
You know.
Yeah. This is from his last letter, so we did read over this, and it's so true. It's like, the real test of time is, what can you do over the long run, and also look at me and how I'm doing when there's a down run. How protected am I? It's that's pretty great.
And he's like, yeah, just because market's been doing ridiculous things in the past 5 years, or what did it say? The decade. Yeah, the decade. The last decade, market's been doing well. On average, market should you typically gives 5% per year,
Yep.
including dividends and market gains. So lower your expectations for the future with the market.
Let me quickly say, so his most optimistic for the shareholders, at least, I'm sure he's pretty ambitious himself, is that he wants to get to 15% compounded interest rate while beating the Dow, which is at 5%. So if he does 15%, he's like, wow, here you go, you guys, I killed it. But really, he's performing 5% more than that, close to 20%. So pretty great.
Correct, correct. So yeah, his target is 10% above the Dow, and but I don't think he's looking at relative. He's looking to maximize his absolute returns,
Yeah.
and he thinks he'll land closer to Dow or it's like 10% better than Dow. That'd
Yep.
be good.
So really, he was like having an office in his bedroom, I guess. My
Yep.
God. Man, I did not do this when I'm in my bedroom, that's for sure.
Surprising as it may seem, the
He was talking about his kids too. Oh, that's
it's
so
like
funny.
it was sold. Never mind. So much more money.
Yeah, right. And
Bill
I mean,
Scott,
they
yeah,
make up, let's say all of those guys made up about $1 million,
yeah,
and that means his total net assets was 9 million. So he either got 8 million through all of his other partnerships or himself.
yeah. So the Buffett family has about 2 million
Yep.
in it, and the 9.4,
Yeah.
or and the rest, let's say 7 or 8 are from outsiders.
Yep.
Bill Scott, who what
And
time schedule?
he's writing 3 letters every year. What's going on? He's got plenty of time.
Susie was in charge of equipping the office, which means we did not follow any orange grid approach to ensure decorating. We have an ample supply of Pepsi on hand. Pepsi? And I look forward to partners dropping in. Oh, he's inviting
Interesting.
people. Beth
He
Freehan.
doesn't mean stock, that's for sure. He just means Pepsi, literally.
Yeah.
But I
Yeah.
like how he's pretty self-deprecating. He's like, "Hey man, if you came to my house and Susie wasn't around, it would look like an orange crate. So I'm glad she's around and she's
Yeah. I can't even
decorating."
afford Coca-Cola. I have Pepsi for you. So I don't want to.
Yeah.
Beth Freehan continues to demonstrate why she is the high priestess of the CPS, Certified Professional Secretary, that is group. Oh, he is secretary now.
Hmm.
Partners did a wonderful job of cooperating in the return of agreements and commitment letters, and I am most appreciative of this. It makes life a lot easier. And close, you will find Schedule A to your partnership agreement. You will be receiving your audit and tax figures very soon. And if you have questions on any of this, be sure to let me hear from you. Cordially, Warren Buffett.
Interesting.
Wow.
Yeah.
What a letter. I feel like
That's a
that. I
long
mean, if
letter.
you're going to read one letter, I mean, you could just read this one and it
Yep.
will at least highlight his philosophy. I mean, you'll miss out on some of the businesses he's talked about, like the mapping business.
Yep.
But it's kind of repeating the same things, and he probably still repeating the same things.
Yeah. But interesting. Yeah. It sounds like he's kind of made a name for himself. He got a lot of money now. He's still not slowing
Yeah,
down.
I
And
would definitely
it's been
invest in him
5
at this
years.
point. I
Yeah.
would give some money.
Yeah, yeah. Well, we wouldn't be able to maybe
Oh yeah, we
because
won't
two
be
hundred
able.
thousand would be the minimum I think he
Yeah,
takes.
he won't accept
Yeah,
our money. We'll be too poor for him. But
yeah, yeah. At least
maybe
we
I
can
could.
sit outside his door or something and just be like, "Hey, man, let me learn from you."
Yeah, yeah. Or we could like gather a lot of people and just pool our money together and like, here, man, take
Yes.
this, okay?
Oh my god.
Yeah.
Yeah, he's killing it. I can't. Yeah, I mean, even the 5 year mark, which was his own benchmark, and we have that data now. There's something special about this kid. You know what I mean? There's
No,
but
yeah.
no, anyone can be
I
hot for a year or two, but not
think
5.
a lot of it's psychology and just discipline. Like he
Yeah.
just knows what he wants and he's just going for it and
Yep.
doing his own research and doesn't care about what people are saying
Yep.
and is balancing the workouts and and the generals and has a good strategy.
Yeah.
Most people are
Yeah.
like, "Oh, you need bonds and stocks." There's like, no, you need generals and workouts.
Yeah, yeah, and control, I guess. So like it's pretty awesome. Those 3 categories I had no idea about. I don't know if you had any idea that he thought about businesses at the early stage of his career in those 3 ways. I don't think I had.
Yeah,
I mean,
and
I
I
didn't know
put the
that.
controls in as generals. I think all generals are failed control. I think for him, I think it's like if you can buy enough and achieve, then it's a control. So I kind of say,
Mm, mm.
I think he's when he can, he's trying to take an active role.
So
And
you're saying he's trying to convert generals into controls?
really saying most of the time, stock price goes up and he can't have a
Hmm.
controlling share, though he would like to. I think most of the time.
Yeah,
But yeah, so I think to me it's just like stocks and the workouts. I think that those are the two big buckets.
yeah. Very exciting. Very, very
Very
cool.
exciting. That is the
Yeah.
conclusion of 1962.
Yep. That's right.
And his first purchase of Berkshire
Berkshire.
Hathaway stock for his partnership. And and he already, he has experimented with like Dempster and then owning stock under that corporate structure. Because
Yeah.
I mean, obviously he'll transition to that with Berkshire Hathaway.
Yep.
But it's incredible, incredible. He just moved into
Yeah.
the office, is working with his dad,
Yep.
and I hope that goes well.
Yeah.
Yeah, it looks like
Yeah.
a good year. It's a very positive letter.
Yep. Exciting stuff. Excited for
So,
1963.
yes. When does his
So,
dad pass away? Was it in 1962?
I thought when he did buy Berkshire for the first time because he got cheated and all that stuff. But maybe it was a substantial portion in 1964.
Oh, it was 1964.
4.
Just
Okay.
2 more years.
Yeah,
So I think he started at that point. He does the buyout. He does
that's
buys
right.
a lot more.
Yeah, yeah, and he has the partnership, Berkshire Hathaway partnerships. That's when he starts it. So, you know, um, since should be
Yep,
exciting.
yep, yep.
Yep. All
All
right. Well,
right,
that
all right.
concludes 1962.
1962. Till next
Nice.
time,
Till next
guys.
time.
All right. Bye.
Bye.